Good morning, everyone watching live here on BAM YouTube. Let me know in the comments where you're tuning in live from on this Monday morning. The Hot Sheet covers what you need to know about the real estate industry in a 24-hour time period. And on today's Hot Sheet, I will discuss the housing standoff, inventory versus home prices, and the 10 most popular metros for relocation. Today is Monday, March 6th, 2023. I am Byron Lazine, and the Hot Sheet starts now. Can you believe it? We are at week 8 of the Hot Sheet every single Monday through Friday live at 9:30 a.m. Eastern. If the markets are open, we bring this show to you, and we're going to bring the show to you all week here. I'll be in a couple different places, but we're excited to continue to deliver this show so you have that 24-hour look back on the housing market. Hit the thumbs up if you appreciate that, and consider sharing this show with one person who can benefit. Okay, just this morning, I think it was, I guess the 7 o'clock Eastern hour, maybe 8 o'clock Eastern hour. Logan Mohtashami from Housing Wire, chief economist of Housing Wire, was on CNBC, and he talked about the housing standoff. I've been talking, and to Logan's credit, he's been using the word standoff for a long time. When I first spoke about this in Q1 of 2022, I used the phrase the Cold War of real estate, where we would basically just have sellers and buyers staring each other down as we continue to move through volatile times with the interest rate. And I was definitely right if we look back to what happened in the second half of 2022 and what's happening right now. If we go back to 2015, here are some of the cliff notes from Logan's couple of minutes on CNBC. If we go back to 2015, new listings at this time was 77,000. We've been talking last week and the week before about new listing inventory across the country, and right now we're at 49,000. We're at a ridiculous low for new listings this time of year. This is the time of year we usually see new listings come up. We know we need new listings across the board, right? We've been talking about this for quite a while. He also mentioned that the more supply would be the best way to fight inflation. Okay, we desperately need supply. And I'm going to talk a little bit here on topic 2 about inventory versus home prices. Okay, what happens if we get more supply? What's going to happen to home prices if we actually get the supply during the spring market that we normally would? What would happen to home prices then? I thought the biggest takeaway, though, was Logan mentioning that people live in their homes longer, and that this interest rate environment that we're in, where 99% of mortgages are actually lower than today's mortgage rate, people living in their homes longer naturally, this is only going to keep people in their homes even longer. This Redfin chart shows us exactly what is happening, where the typical U.S. homeowner spends 12.3 years in their home. This chart and all of our sources will be available for you down below in the daily download link. You can get one link to get everything. Think about 2005. People were spending 6.5 years in their home. 2006 was 6.7. Look at this. It didn't get until 2012 where the typical homeowner spent 10 plus years in their home, and it has been on a consistent increase since then. Okay, topping out in 2020 at 13.4. Obviously, in the last couple of years, we saw a whole bunch of movement. 2021 dropped down to 12.9. We're at 12.3. The rule of thumb has always been like 7 to 10 years people will spend in their home. And I know a lot of metros across the country will use that number still today, 7 to 10. But across the country, we're actually seeing 12.3 years in a home. Well, if interest rates stay at 6 and 7% for years, could that number not go up? When we look at the 2023 number, could it not go back up to 13? I certainly think it could. Let me know in your market what you believe the typical homeowner spends in their home. If you've got some data on that, love for you to comment. I know in the Northeast, it's on the higher side, right? So a real transient community, and I see Jeremy Knight, shout out to Jeremy Knight and his channel that he's got in Austin, one of the best probably the best local channels, YouTube channels covering a local market. I know Austin is a little bit more transient, so it's probably lower in that market. I don't know if Jeremy's got a number on that for Austin, Texas in particular. Northeast would be on the higher side. Across the U.S., again, according to Redfin, it's 12.3 right now. So people are going to stay in their home longer, which is going to suffocate the inventory that we need. 99% of homeowners with a mortgage have a mortgage rate lower than today, and people are naturally spending more time in their home because it's just not fun to move, right? Because home prices have accelerated so much, and that move up is as hard as it is, let alone with a higher interest rate. We're going to see more inventory on the sidelines. And what Logan calls the standoff and what I call the Cold War is something that could get extended longer than any of us want to see. What homeowners are seeing right now in the national headlines is the one like we have up today on Wall Street Journal. Housing market momentum stalls as critical spring season approaches. This certainly will be a critical spring season for what's going to happen over the next 2 years. Okay. If we don't get the inventory onto the market right now, we're going to talk about that here in just a second. If we don't get the inventory that we're accustomed to seeing, I believe prices, we're going to have an issue with prices long term. Okay. Glenn Kelman had a quote in here from the Redfin CEO. Buyers are starting to step back, meaning step back, regress from the market. CEO of Redfin Corp. I have never seen home buyers more rate sensitive in my 17 years of running this company. That just stuck out to me. Okay. If we do the math, 17 years ago was what? I should have done this before the show. 2020. We're talking about 2006. Let me know in the comments if I got 23 minus 17 correctly. I don't know. I hope so. 2006 we'll go with. Redfin. That means Glenn Kelman would have started Redfin in 2006 as a startup. Okay, as a startup. We know obviously what happened 2007, 2008, 2009. I would argue that's the best time to be a startup like Redfin. During those years, Glenn's got way more experience in it than I do. Obviously, he's done it. He's built Redfin into a monster over a 17-year period. So, he may tell me there was other years that were more challenging or that maybe, those years were not the best time to start up Redfin. Anyways, I would argue that, in your 17 years of running this company, certainly rates, have never been more rate sensitive. If we ask Gary Keller, I don't know, dude's been doing it for, 40 to 50 years. If we ask Bill Ravis, somebody that's been doing it for 50 years, if we ask, Remax, where they've been doing it, they just celebrated their 50 years, then you're probably going to get an answer where, there was other times where rate sensitivity, because I don't know if you remember in the comments, there have been interest rate times well over 10%, 14%, right? And I would imagine that during those times, it was a little bit more rate sensitivity. But in the 17 years that Redfin has been in operation, for the most part, outside of those first few years, right, 06 to let's say, 11, we've been on an appreciating market with historically pretty low mortgage rates. Okay. So I thought that stuck out to me, but certainly we are seeing rate sensitivity right now. We know what happened when we were at 6% in the beginning of the year. Buyers reacted and came out and started to really get aggressive on their home shopping. And we've seen in the last couple of weeks at 7% that we've seen mortgage applications decline. I know a lot of agents, and maybe in the comments, you're going to say, I don't know, I had a really busy weekend, Byron, but the mortgage applications across the country tell a different story. There is less demand right now. We are at a massive constriction of inventory, which is creating this feeling for agents in certain price points in certain metros as if that, oh my gosh, there's incredible demand. Okay. If we had the inventory that we're accustomed to having, this demand would not feel as strong as it does right now with a near all-time low inventory level. Okay. But these are going back to the Wall Street Journal here for just a second. These are the reports that people are seeing. Okay. If I'm thinking about selling in 2023, housing market momentum stalls that may stall my mentality as a seller. Oh, I don't know if I want to sell right now because the market is stalling. I'm not going to get a good price. But we know with the lack of inventory, if you're an agent, you know with the lack of inventory right now in particular price ranges in almost every city in America, you can get near peak level prices right now, and that may not be the case throughout the year. So make sure as your sellers are reading this one from Nicole Friedman, who does a great job covering Housing Wall Street Journal, this article that was released at 5:30 a.m., as they're maybe right now having their English muffin and coffee or tea and reading the Wall Street Journal, they are not getting confused by what this means by the opportunity to be a seller in early 2023. See, I believe that if you're going to be a seller, it's got to be now. It can't be later in the year in 2023 if you care about prices, if you actually want to get the most money on your home sale. Let's go over to prices and talk inventory versus prices for just a minute. Prices have been falling month over month for the first time since 2012. That's just the reality of the U.S. housing market. Okay, we talked about this on a previous hot sheet. So even with inventory being tight, prices have been falling month over month. Okay, so I've got a chart here, inventory versus housing prices, that I'll pull up. Again, all of the access to our sources and charts can be found down below. Okay, this one shows you here that as we get anywhere close to 6 months of inventory in any given market, okay, there we go. As we get anywhere close to 6 months of inventory, which is this line right here, okay, anything over 6 months, which is on the bottom half of the chart, interestingly enough, anything over 6 months of inventory is when you start to see decreases in price. Okay, that's when you really start to see decreases in price because it becomes more of a buyer's market. It means there's more inventory sitting for longer. But you get these increases in price when you see under 6 months of inventory. Okay, so we have very, very little inventory, but interestingly enough, in the environment we're in right now, according to Case Shiller, we've seen month over month declines in home values for the first time since 2012. That being said, new listings are down 15.2% year over year. This is why certainly anywhere close to the median price point as a seller, with inventory being down so low from a low point of last year, this is new listings, right? Total inventory is up a little bit, but new listings being down. My new fresh competition coming onto the market as a seller is basically non-existent. So I've got an opportunity to be maybe one of one in my price range, maybe the one house that actually had pride of ownership, that is really, truly move-in ready and something that a lot of buyers are going to desire. Those are the houses that you're seeing agents tweet about over the weekend, that making a Facebook post or an Instagram story about how they had 10 offers this past weekend, or they had an open house where it was 30, 40 people on Saturday and another 40, 50 people on Sunday. I'm thinking about an agent on my team up in Connecticut. Shout out to Heidi DeRusso, who did a open house on Saturday and on Sunday and posted on Instagram story how many people were coming through, how she spent the rest of the weekend following up on buyers and letting them know, yes, we're collecting offers and we're going to be going ahead on Monday and making a decision on how to move forward with the abundance of offers that seller has. Now, that being said, that particular listing was, and you can put that comment back on, I'll take a look at it. That particular listing was below median price point. So that's what we're seeing right now, median price points and below, where despite the inventory levels being down 15.2%, on new listings, you're going to see these median price points that are move-in ready really get a lot of activity. Active listings are up 67%. New listings are up 17% in Houston. So Houston's telling a different story than nationally being down 15% on new listings. Las Vegas market, 30% retirees, and they stay 15 plus years. So Las Vegas, the first topic we talked about with how long people are staying, Las Vegas is even higher. Vegas has 3,000 people moving here every month. So that affects the price stability. Okay. So I love this local data we have coming in. Ruthie also says we peaked at 120 days of inventory. Now it's 70 days. 30% of our inventory is the median price point, 425 or lower. Okay, so you're seeing different things in different pockets. It's why it's important to take Wall Street Journal headlines, let your database know where this is accurate or not accurate for your market. Real estate version of ESPN's Get Up. Luis, I'll check out Get Up. I'm more accustomed to First Take. You know, I love my debate style shows. Shout out to Ricky Caruth for debating me last year. We got to get another debate going. I love that kind of stuff, but I love this stuff too. And I appreciate the compliment. Thank you. I'll take it as a compliment unless you hate Get Up, but I'm assuming you like it. Appreciate it. All right, let's take a look at that new listing count. This will obviously be available in that daily download. Down below, one link where you can get all our sources and downloads. New listing count according to Realtor.com. This is a Lance Lambert chart that he put together from Fortune. There's not a lot of homes going on the market. This is that 15.2% new listing drop across the country. Okay, so if I'm in, I think it was Houston. If I'm in Houston from the prior comment, where it's like, okay, our new listings are actually up 17%. Okay, our new listings are up 17%. I believe that's what you can put that comment back up, Bobby, if it's still available to you. I believe he said new listings. Okay, not that one. That was Ruthie. I believe it was before that, the Houston comment. Okay, so South House Living, they said active listings are up 67%, new listings are up 17% in Houston for February. Okay, so this is a total opposite scenario of what we have here in the country. You see here, February 2023, new listings down in comparison to this time last year. This is new listings, and total inventory across the country is up a little bit, but new listings is down. Okay, so 15.2% down across the country. My market, let's say Houston, up 17%. I want to be real aggressive with sellers to let them know that we are moving faster than the rest of the country, which means our price drops are going to be more significant right now. Our valuations of our homes are going to take a bigger hit quicker. And if I'm selling in 2023, we shouldn't even be worried about like some of the little things of like, I don't know, should we wait later in the spring or, should I be organizing my closet? You should be doing that as you get ready you got to get this thing on the market is my point, because you are losing money every single day as the inventory comes up. We need a massive increase in inventory to actually cool off some of these median price points. If we get the inventory levels that we're accustomed to getting in the spring, then you will see price decreases in almost every market in America. Okay, we're seeing it in some markets in America right now where you're seeing price decreases. I'm assuming Houston is one of those markets experiencing that right now. You start to get inventory in every market, that's where you're going to see these decreases. 7%, close to 7% interest rates, even 6% interest rates. We know what that has done to demand. We know how many less buyers we have this year than we did last year. It's over 40% on mortgage applications. So if now we get the inventory increase, that's where we're going to get these price drops, right? That's where we're going to get opportunities if you yourself are looking to invest in real estate at a discounted price from what we've seen the last couple of years. Doesn't mean we're going to have a 40%. Doesn't mean we're going to erase the last 2 years of equity. Okay. Now, if the standoff continues, like we've been seeing here for the last year, and we don't get the inventory, that's where you're going to see prices not really move that much, right? Zillow actually believes we're going to go up, a couple points. Goldman Sachs just believes we're going to lose 6%. A lot of these economists are between this, 5, 6, maybe some of the extreme ones are closer to 10% loss in values. And then you've got some that are actually believe will go positive across the country in home values. It's all dependent on inventory, which to me is all dependent on jobs. Good news is this week we've got a couple more job reports to go over. So stay tuned. Make sure you're subscribed to the hot sheet so you don't miss any of those job reports. Okay. Jobs also impact relocation. And I've got nowbam.com article here for you, which we'll link down below, for the 10 most popular metros for relocations. Okay. This is according to a new Redfin report, which shows a record share of home buyers on redfin.com are looking to relocate as high housing costs drive almost 25% of them to more affordable metros. Miami's the #1 migration destination by net inflow, while San Francisco, LA, and New York rank as the top 3 migration origins by net outflow. This is reminiscent of the study that we talked about with U-Haul, right? Where Florida was the #1, U-Haul migration, according to their study. And you saw that California and New York were there in the bottom. So very, very much similar to what we've been seeing. Okay. The share of relocating homebuyers is 0.4% higher than Q4 22 and up from 23% a year ago and about 18% before the pandemic. I think that's a really interesting number there. This is the share of Redfin home searchers who look to relocate in January. Okay. You can see that this is been on the rise here for quite some time. So steady increase on people looking to relocate. You see that it did pop up in 2020, 2021, took a little break here, and now is up again, even above those pandemic levels. Really interesting, right? As now people's job market shakes out and, they see where the prices are and the opportunities across the country, more people are looking to move. You can put that new construction comment back on from Sarasota, loving and living in Sarasota. Love Sarasota. When new construction catches up and the builder offers their own rate cuts, when new construction catches up and the builder offers their own rate cuts, move in money, ? Well, I think that's going to happen again. Home builders are going to have to get creative. They're more creative than homeowners and banks when it comes to getting people into their product, right? Because every day that goes by, they're literally losing money. So I don't know if that was a question, but yeah, I think I would expect builders to continue to be creative throughout 2023. It's what we saw in January, where builders have been very creative and very competitive with their financing as opposed to what buyers can get on financing of existing homes. Here are the top 10 metros home buyers are moving into based on net inflow. Okay. So if you're in one of these markets, I'd certainly be taking advantage of the opportunity. Miami #1, Sacramento #2. Okay. So this may be people leaving maybe San Francisco, going to Sacramento because they can get a bigger bang for their buck. Las Vegas #3, Phoenix #4. I'll be in Phoenix a little bit later this week. Tampa 5, Dallas #6, Cape Coral #7, Orlando, Florida 8, Northport, Sarasota area is #9, and then Houston #10. So, wow, Houston, what an opportunity with what we saw from somebody in the chat today, where Houston has inventory up 17%. Overall inventory, I think, was up 70% according to their numbers, and new listings were up 17%. And we're seeing that, okay, buyers want to move in there. So what an opportunity for these buyers looking to move into that metro. I would imagine, based off of our first story there, where we're talking about people staying in the homes longer, that Houston's probably on the lower side. Okay. If our Houston agent is still with us, let us know. That would make sense to me. You do get a lot of turnover in Houston. Okay. So here's where you've got lower outbound and higher outbound. Okay. So you can see the chart there. This is again, according to Redfin, and it's really coming out of that Southern California market and going, what looks like northwest, southeast, and into the south, right? People are spreading all over there. Certainly some of the taxes and those kind of things having an impact on outbound. Okay. Here are the top 10 metros home buyers are leaving based on the net outflow. We talked about San Francisco, LA, and New York. You've got DC #4, Chicago 5, Boston, Seattle, Denver, Hartford, and Detroit. Interesting. Hartford was named earlier in the year as a market for #1 opportunity. So interesting to see that. Okay, there you go. That is your inbound and outbound study from Redfin. We've got it linked below where you can dig deeper. If you're in any of those markets, I'd definitely be grabbing that information, using it in my email newsletter. whether you agree or disagree that there's going to be an opportunity there for you to leverage that headline and get people's attention that live in your community. Good news on the 10-year today. So we're starting Monday off on a good note. Happy Monday, everybody. The 10-year is down just a tick. We're at 3.941. We know that when we're over 4%, we do see 7% on the 30-year fixed mortgage handle. The housing market follows this 10-year very closely. We're going to continue to follow it every single day. It's been at one of its most volatile jumps, every single day. So we're going to keep looking at every single day and see where things could be heading. I would imagine hopefully our 30-year fix today, when it comes out later, would be down a tick like we saw on Friday, right? We saw Friday that the 10-year dropped from over 4 to just under 4, and we went from 7.1 to 697. So maybe we'll get a little bit more relief on the 30-year fix today. Okay. Also today at 11 a.m., we've got Overask podcast going up today. And Eric, by the way, the broke agent, getting married later in this week. So there's going to be some interesting hot sheets as I'll be on West Coast time and doing these without Bobby, the producer, being with me. So we're going to be going full remote mode hot sheet. It's going to be a little bit more down and dirty this week, but we want to continue to deliver the information that we need to review the housing market in this 24-hour look back each and every single day. Really hope you are having a great start to your day. Let's have a great Monday, and we'll be back here tomorrow live at 9:30 a.m. Eastern. Until then, toodaloo.